You've got $100,000 sitting in your account. What you do with it next could be the difference between building real wealth or watching inflation slowly eat it away. Do you put it into the stock market and let compound interest do the work? Or do you use it as a down payment, buy real estate, and let leverage build your wealth faster? This is one of the biggest money debates in America. $100,000 in stocks versus $100,000 in real estate. Which one actually wins? Let's start with stocks because most people underestimate how powerful this option really is. If you put $100,000 into an S&P 500 index fund, you are basically buying a slice of America's largest companies. Apple, Microsoft, Amazon, Nvidia, Berkshire Hathaway, JP Morgan, the businesses that drive the U.S. economy. Historically, the S&P 500 has returned roughly 10% per year on average over the long run when dividends are included. Now, that does not mean you get 10% every single year. Some years are amazing, some years are terrible, and some years feel like the market is personally trying to ruin your life. But over long periods of time, the U.S. stock market has been one of the strongest wealth-building machines in the world. So let's run the numbers. If you invest $100,000 into an S&P 500 index fund, and it compounds at around 10% per year, after 10 years, you would have roughly $259,000. After 20 years, you would have around $672,000. And here's the beautiful part. You didn't need a bank. You didn't need a tenant. You didn't need a property manager. You didn't need to fix a roof, replace an HVAC system, or answer a phone call about a broken toilet at midnight. You just bought the fund and let time do the heavy lifting. And there's another advantage that people don't talk about enough. With stocks, you can start small and keep adding. You could invest the $100,000 today, then add another $500 per month into the same index fund. Do that for 20 years at 10%, and you are not looking at $672,000 anymore. You are looking at over $1 million. That is the quiet power of dollar cost averaging. You invest consistently. You ignore the noise. You stop trying to time the market. And slowly your portfolio becomes a boring but beautiful wealth machine. But here's where things get interesting. Because real estate investors have one advantage that stock investors usually don't use at the same scale. It's called leverage. And this is where the debate changes completely. With $100,000 in stocks, you control $100,000 worth of stocks. But with $100,000 in real estate, you might use it as a down payment and buy a property worth $400,000, $500,000, or even more, depending on your income, credit score, debt, and lending conditions. The bank lends you the rest. So your $100,000 is no longer just $100,000. It is controlling a much larger asset. Let's say you buy a $500,000 investment property with a $100,000 down payment. That means your cash is controlling a $500,000 asset. If that property grows by just 5% in 1 year, the property increases by $25,000. But you did not invest $500,000 of your own money, you invested $100,000. So that $25,000 gain is a 25% return on your cash before costs. That is why real estate can feel so powerful. The return is not just based on your down payment, it is based on the full asset value, that is leverage. And leverage is the reason many Americans have built serious wealth through property. But we need to be honest, real estate is not free money. The U.S. housing market is expensive. The average home value in America is around the mid $300,000 range, but in many major cities, that number is much higher. A $500,000 property may be normal in some areas and completely impossible in others. And right now, mortgage rates are still much higher than they were a few years ago. A 30-year fixed mortgage around the 6% range changes the math dramatically, because when interest rates are high, your monthly payment is high. And when your monthly payment is high, your cash flow can disappear fast. Now let's talk about rent. A $500,000 rental property might generate decent rental income depending on the city. Some markets may give you strong gross rental yields. Others, especially expensive coastal cities, may give you terrible cash flow. You might collect rent every month, but then you have to subtract mortgage payments, property taxes, insurance, repairs, vacancy, property management fees, HOA fees, maintenance, and unexpected surprises. Because real estate always has surprises. The water heater breaks, the roof needs work, the tenant moves out, the city changes rules, insurance premiums rise, property taxes increase. And suddenly that passive income does not feel very passive. But real estate also has tax advantages. In the U.S., rental property owners may be able to deduct expenses like mortgage interest, insurance, repairs, property management fees, and depreciation, depending on their situation. That can make real estate attractive from a tax perspective. But again, this depends on your personal income, tax bracket, property structure, and whether the property actually qualifies. So this is where people make a mistake. They compare stocks and real estate as if both are simple. But they are not simple in the same way. Stocks are simple to buy. Real estate is simple to understand emotionally. People like real estate because they can see it, touch it, drive past it, improve it, rent it out, pass it down. There is something psychologically powerful about owning a physical asset. But stocks have their own kind of power. They are liquid. You can sell $5,000 worth of shares if you need cash. You can invest from your phone. You can diversify across hundreds of companies instantly. You don't need to negotiate with a tenant. You don't need to deal with city permits. You don't need to worry about one neighborhood collapsing in value. One S&P 500 index fund gives you exposure to hundreds of major American companies. Real estate is different. One rental property is one asset, in one city, in one neighborhood, with one tenant. That can be powerful, but it is also concentrated risk. So let's compare the numbers more clearly. If you put $100,000 into stocks and get 10% per year, after 20 years, you may have around $672,000. If you add $500 per month, that could become over $1 million. Simple, liquid, low maintenance. Now in real estate, if you use $100,000 to buy a $500,000 property and that property grows at 5% per year, after 20 years, it could be worth around $1.3 million. That sounds much bigger. But remember, you also have a mortgage. You have interest costs. You have repairs. You have property taxes. You have insurance. You have closing costs.
Okay.
And you may have periods with no tenant. When you buy property in the U.S., you also need to account for closing costs. These can often be around 2% to 5% of the loan amount, depending on the lender, state, loan type, and property. So your $100,000 does not all go into the down payment. Part of it disappears before you even get the keys. With stocks, your entry cost is almost nothing. Many platforms now offer commission-free ETF investing. That means almost all your money can start working immediately. But property gives you something stocks usually cannot. Control. You can renovate, you can improve the kitchen, you can add a bedroom, you can increase rent, you can refinance, you can house hack, you can turn a basement into a rental unit if local laws allow it. You can actively force value. With index funds, you are a passenger, a very well-rewarded passenger, but still a passenger. You don't control Apple. You don't control Microsoft. You don't control the Federal Reserve. You just ride the market. And that brings us to the biggest difference of all, behavior. Most people do not fail because they picked the wrong asset. They fail because they cannot hold the asset long enough. Stocks are easy to sell, too easy. One bad headline, one market crash, one recession fear, and people panic. They sell at the bottom. They wait too long to get back in, and they destroy their own returns. Real estate is harder to panic sell. You cannot sell a house at 2 a.m. because CNBC scared you. There are agents, contracts, inspections, timelines, closing processes. That friction can actually help people stay invested. The mortgage also creates forced savings. Every month, part of your payment may build equity. That discipline is one reason real estate works so well for many people. Not because real estate is always mathematically better, but because people are more likely to stick with it. So what actually wins? Here's the honest answer. If you want simplicity, liquidity, diversification, and low maintenance, stocks are incredibly hard to beat. Put your money into a broad U.S. index fund. Keep adding consistently. Reinvest dividends. Ignore the noise and let compounding work for decades. That is one of the cleanest wealth-building strategies available. But if you want to use leverage, build equity, collect rent, use tax advantages, and actively improve an asset, real estate can build wealth faster. especially if you buy in the right market at the right price, with the right financing, and manage the property well. But real estate comes with more complexity, more risk, more debt, more paperwork, more stress, and more things that can go wrong. So the real winner is not stocks or real estate. The real winner is the person who understands both. Stocks build liquid wealth. Real estate builds leveraged wealth. Stocks give you diversification. Real estate gives you control. Stocks are easier. Real estate can be more powerful. Stocks can compound quietly. Real estate can accelerate wealth if managed well. And the people who become truly wealthy often don't choose only one. They use both. They build a stock portfolio for long-term compounding. They use retirement accounts like a 401k, IRA, or Roth IRA when it makes sense. And they use real estate carefully, not emotionally. Because the goal is not to win an argument online. The goal is to build wealth that actually gives you freedom. So if you had $100,000 today, what should you do? If you want less stress, more liquidity, and a simple long-term plan, stocks may be the better choice. If you want leverage, control, and are willing to deal with debt and property management, real estate may be the better choice. But if you want the strongest long-term strategy, learn both, use both, and never forget this. The best investment is not always the one with the highest return on paper. It is the one you can understand, afford, manage, and hold long enough to let it work. Because whether it is stocks or real estate, wealth is not built overnight. It is built by staying in the game. If this video helped you think differently about your money, hit the like button and subscribe for more straight-talking American finance videos. Thanks for watching, and I'll see you in the next one.